welcome. You're watching the Small and Mid Cap Show. I'm Mahima Vachajani. With me is Harsh Saita, and we're also joined by Anushi Vakaria.
Let me welcome on board Mr. Ashok Atluri, who's the CMD at Zen Technologies. Welcome, first off, Mr. Atluri. Congratulations on the fundraise. You've seen good investor interest also come through. Just talk us through where the funds are going to be utilized. What's the plan going forward?
Hi, good morning. So the focus, Harsh, it's going to be on, the acquisitions, inorganic growth acquisitions that we are looking at. And the acquisitions would primarily be focused in the area of simulation and electronic warfare. That's towards anti-drone systems. And we have raised about 1,000 crores and including, and we are also planning to do some, deploy some of the funds that we have sought towards working capital, and of course, the general purpose like deeper R&D in the products that we have, and explore some capex relating to buildings for assembling spaces. We are doing that. Otherwise, this is the main thing is acquisitions and working capital.
Okay, Mr. Atluri, my next question to you is, in terms of order book, your order book stood at roughly 1,150 crores, and you had new orders worth rupees 11 crores approximately in this particular quarter that has gone by. So I want to understand firstly, what are the kind of execution timelines of the order book that is there at present, and what is the kind of guidance in terms of new orders that you're expecting overall in FY25?
So, the order book, out of the order book, we are saying that, we will execute another 650 crores. So, that is that will take us to 900 crores of turnover during the year. And we expect the order expectation is that towards the third quarter, end of third quarter and fourth quarter, we'll be getting substantial orders. And, that will take us closer to our goal of 50% growth rate of for the next year, which is about 1,350 crores of turnover next year.
Okay, so that's a strong outlook that you've given, about 50% of growth. Now to come to your growth projections over here, it's not just for FY25, even beyond FY25, you've mentioned, or you've rather guided for a 50% of our revenue CAGR going forward. For how many years are we expecting this timeline, and in this, how are the new products going to contribute going forward?
So we have said that at least for the next 3 years, the 50% CAGR should be achievable. And so given the current situation, we expect the support from the government is tremendous, and that's actually a conservative figure for us. But let's see how it pans out. And the government is going, completely full-fledged into both training mode, because, thanks to the, the realization that has come after the Ukraine-Russia war, where Russia is able to really withstand all the new weapons that are being deployed with the thing. But Russia is primarily using all old-time, 21st century equipment, and they are using 20th century equipment, and they are using. But why they are able to beat it, mostly it's boiling down to well-trained soldiers. So the training has suddenly become important worldwide. And of course, the drone threats are becoming larger and larger. You have seen being extensively deployed in Ukraine-Russia war. So anti-drone system is the second thing. And so we are in the sweet spot that the two biggest requirements for the armed forces worldwide, the simulators and the anti-drone systems, are being made by Zen. So we are in the sweet spot. Yeah.
Got it. So you're basically expecting an FY28 revenue of around 3,000 crores. So if I were to just extrapolate some of these numbers, you've guided for 1,350 crore FY26, 2,000 odd crore FY27, and FY28 at 3,000 crore top line. Just talk to us about the product service mix and how margins will likely shape up as you head towards that 3,000 crore mark.
So, so I'll give you two mixes. One is, we have the anti-drone systems and simulators. We think that probably it may be a few, generally it has been, in favor of simulators, but we see the demand exploding in both the ends. So, in a best case scenario, it may be 50-50, or a simulator may be 60 with 40% of the revenues from this. And the second is domestic versus export. while export order book out of the order book, we have only 400 crores of exports. We expect that the exports will be about 40 to 45% as we go ahead of the thing, of the revenues. Yeah.
Okay, so you mentioned that there would be a significant pickup in exports from Q3 onwards. So with that, where should our margins be lying at? Because if you look at the Q1, that was at about 44-45% of a margin range. So do we expect a ramp up in our margins as we go forward for the quarters? Can you give us a sustainable number that we should be looking at for not just this year, even for the near term 1-2 years? Where does our margin number look at?
So EBITDA margin, we are saying that conservatively it should stay at 35% and PAT at 25%, going into the future all the way up to 28, yeah.
And a breakup between the two, if we look at between the simulators and anti-drone, simulator has higher share over here. So can you give us a breakup between the margins for both of these as well?
So as of now, the simulators have much better margin, and because we are entering into the anti-drone space, and so we have been a little aggressive, and there the mix, the margins have been in the range of maybe 40% or something like maybe 30% or so, compared to 40% for simulators.
Okay, Mr. Atluri, I want to understand that, in terms of both these products, what kind of market share you have right now, and what is the kind of market size, and how much of an expansion are you looking at from a long-term perspective?
So, what we have seen is, there is a category called IDDM. When India buys in the defense, IDDM means indigenously designed, developed, and manufactured. The IP ownership should be with the Indian company, and they really go through the source code. They look at the Gerber files, the mechanical drawings, are very, very deep analysis they do. So we had the two procurements in 23. In both the procurements, we were the resultant single vendor. There was nobody else who qualified technically in that. So so based on that, we think that there is still a lot of investment to be done by competition to actually prove to the Indian Armed Forces that the product is really developed by us. In our case, all the key components, everything is developed by us: the detector, the jammer, the radar, the camera, and so all these are in-house developed by us. So we are able to bid very aggressively, and even overseas, we see it as a huge potential. So we are looking at the overseas market also with this product, both the simulators and the anti-drone systems. Yeah.
Right, sir. So capex requirements for getting some of these orders executed. What's it like? Of course, you've raised 1,000 crore. Any more fundraisers in the pipeline on the back of that?
No, there's no fundraise in the thing. Again, our model has been, when you look at the value chain from, the R&D, engineering, manufacturing, QA, dispatch, and everything, the manufacturing is the part which takes, a lot of capex. So what we have done, deliberately, because one thing is that we think there are people who do better job than us in manufacturing. And there is a huge capacity in Hyderabad for that, Hyderabad, Bengaluru, and Pune. So we outsource the manufacturing. So the actual investment for plant and machinery has not been much. In fact, when you go 60 to 160 to 430, our investment has been almost zero. But now, because the final integration is done at our premises, now we are building additional building space to accommodate this integration of the facilities. And that we think maybe less than about 50 crores or so. That will not be much at all. Only the buildings will be required.
Understood. So very strong commentary coming from you. I want to just quickly clarify one more piece. With regard to top line, 3,000 crore FY28, 2,000 crore FY27, how much of this component would be annual recurring? Because my sense is a lot of these services would be annual in nature, recurring in nature.
So the structure is like this, that the product that we sell typically has a life cycle of 10 years. The first 2 years are warranty period, and third year onwards, the annual maintenance contracts kicks in. So third year on, so for example, the 1,100 crores that we are talking about will kick in from 27, 28, and we think that the revenues from that would be around from the third year would be around 100 crores of recurring revenue. And these, when we talk about 2,000, 3,000, their annual maintenance contracts will reflect in the future, or maybe 2 to 3 years from there. So I think this will keep growing, but as on 27, 28, maybe about, we think it will be about 100 to 120 crores of AMC, very, very conservative.
Got it. Got it. Okay. Thank you so much, sir. It's been a pleasure breaking this down. Of course, Zen Tech has been a standout performer. Just to try and give context to viewers, 3,000 crore in terms of top line with a 25% PAT margin would essentially mean around 750 crore in terms of profit after tax FY28. The stock is trading at 20 times that, at around 16,000 crore in terms of its market cap. It's of course been a multi-bagger over the 6 as well as the 12-month period. So almost, in fact, multi-bagger over almost a multi-bagger over the 3-month period as well. So very, very strong numbers as well as the kind of returns it's given. So, well, great perspective.
Hello and welcome. You're watching the Small and Mid Cap Show. I'm Mahima Vachrajani. With me is Harsh Saita, and we're also joined by Anushi Vakaria.